The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective. We are attentive to the risks on both sides of our dual mandate. I will review the current economic situation before turning to monetary policy. Incoming data suggests that the economy remains.
Hey folks, welcome back to America First Finance, where we break down the economy with some good old common sense and American values. If you're tired of DC doublespeak and globalist games, you're in the right place. Now let's talk about the latest speech from the Federal Reserve. Yeah, that glorious bureaucracy that pulls the strings on our money supply.
Incoming data suggests that the economy remains solid. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment in recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged a moderate 224,000 per month in the first 5 months of the year. The unemployment rate at 4.2% in May remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that the conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total personal consumption expenditures, or PCE prices, rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. With the labor market at or near maximum employment and inflation remaining somewhat elevated, the Federal Open Market Committee has maintained the target range for the federal funds rate at 4.25% to 4.5% since the beginning of the year. We've also continued to reduce our holdings of Treasury and agency mortgage-backed securities, and beginning in April, further slowed the pace of this decline to facilitate a smooth transition to ample reserve balances. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Policy changes continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that would depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
So here's what the Fed just told us. They say the economy is in a solid position, unemployment is low, and inflation's coming down. Well, let me tell you what that really means for real Americans like you and me. Yeah, unemployment's sitting at 4.2%, but let's be honest. How many of those jobs are part-time or gig work that can't even cover a rent check? The Fed brags about wage growth outpacing inflation, but if you've been to a grocery store lately, you know your dollar buys less every week. They think a few cents more an hour is some kind of victory? Please. They claim inflation has come down to 2.3% PCE, but that's just cooked-up government math. Regular people are still paying more for food, fuel, and housing. When you're struggling to fill your gas tank or feed your family, 2.3% means absolutely nothing. Now here's the kicker. The Fed blames uncertainty on trade policies, i.e. tariffs. Well, I say it's about time we stood up to China and protected American industries. If that creates a little uncertainty in Wall Street boardrooms, so be it. Main Street comes first. They've kept interest rates high, between 4.25% and 4.5% since the start of the year. Now they want to wait and see. But while they wait, middle-class Americans are being crushed by credit card debt, high mortgage rates, and sky-high business loans. You see, the elite can afford to wait. You and I can't. The Fed says their dual mandate is maximum employment and stable prices. But when was the last time their decisions actually helped working Americans? They're not elected, they're not accountable, and they sure as heck aren't working for we, the people. They're slowing their reduction of assets, which is code for keeping their hands on the printing press. Meanwhile, our national debt is exploding, and the dollar's value is being chipped away. You want to fix this? Cut the spending, shrink the government, and let the free market do its job. They're obsessed with keeping expectations anchored. Sounds fancy, right? But it's all guesswork. How about we anchor our economy in production, self-reliance, and American energy, instead of betting our future on central planning? Make no mistake, the Fed's policies don't hurt the elites. It's the small business owners, the farmers, the truck drivers, and young families that are paying the price. They're out here managing risk, while the Fed manages optics. If tariffs raise prices a bit, that's a small price to pay for economic sovereignty. I'd rather pay more for American-made than rely on slave labor overseas. Let the Fed whine. We need to bring jobs home and build real industry again. So what's the bottom line? The Fed talks a big game, but their track record is failure, bailouts, and inflation. It's time to audit the Fed, protect the dollar, and put America first. If they won't do it, we need leaders who will. Let's call issue for patriots. Don't forget to like, subscribe, and hit the bell so you don't miss the truth the media won't tell you. Stay free, stay strong, and stay focused on what matters: faith, family, and freedom. This is America First Finance, signing off.